Hello and welcome to my presentation on how a small part of the financial market can cause a massive global collapse. And we're speaking.
So the beginnings of the financial crisis was really when there was deregulation of the banks in 1999 and 2000, where Congress adopted the Commodity Futures Modernization Act, which essentially helped deregulate the over-the-counter derivatives market. So essentially allowing two counterparties come together and agree the trade without it going through an essential exchange. And this essentially saw a massive increase in OTC derivatives such as credit default swaps. And as we'll see as we go on in this presentation, this really helped create the demise for the institution of the Lehman Brothers. Another tool which helped lay the foundations of the financial crisis was securitization. It isn't the tool itself because it's an excellent tool to shift illiquid assets to liquid and help institutions such as a bank use that liquidity to create profit from themselves, and through either loan creation, which is a positive for the economy as it can help increase investment, and also help the bank increase their profits through investing in interest earning assets such as bonds. The main issue was the behaviour of these institutions, because obviously the demand for mortgage-backed security was increasing between the early 2000s and 2007, which led to banks incentivised to create as many mortgages as possible, despite maybe the risk of that mortgage defaulting. And this led to the rise of the subprime mortgages, as we saw in the early 2000s that of the new mortgages, 9% was subprime. By 2006, they were above 40%. And this would have caused issues further on in the market, as we'll discuss in the next slide. So as we saw the increase of subprime mortgage-backed securities, the securitized mortgage market was steadily increasing lower quality, and which increased the whole risk of the mortgage-backed security market. And on top of this, we also saw institutions start to create these complex securitized products called collateral debt obligations, which enabled institutions to essentially hide the risk of these low-grade junior mortgage-backed securities, and they could group these subprime MBSs with other asset-backed securities, and package them up as AAA rated securities. For example, what we can see here is these triple B mortgage bonds and BB unrated could then be packaged up again in these mezzanine structured finance CDOs and be shown as a senior AAA, junior AAA, for example. And then on top of this, we could also see that to entice investors, we have the institutions offering credit swaps defaults to help reduce the risk of these MBSs, so help boost them from like maybe a triple B to a triple A, because if they did default, then these institutions would pay the principal and also pay the future interest payments they would have received. So now the collapse. So the foundations are set, and all it needed was the right economic shock to trigger it. And considering that the asset-backed securities were majorly backed by mortgages, it had to be the housing bubble pop. So what we can see is that during 2003 to 2006, we see this rapid rise in the house prices, as obviously the demand for housing increased due to the cheap mortgage rates that individuals could acquire. However, this led to the Fed to have to increase the interest rate to keep to their 2% target rate. And what we can see here is that the Fed increased it from around 1%, roughly about 2003 to 2004, and in 2005 increased it to 5%. However, for people with fixed mortgages, this wouldn't have too much of an issue. However, what we could see before this was that in that same time period that the variable mortgages, so they change with the interest rate, the share of mortgages that were on these started to increase as well. So by 2005, roughly, we could see about just shy of 50% of mortgages were on a variable interest rate. So this meant these households who were probably subprime, have lower income to be able to afford these houses, would start to default or delay in payment, and the mortgages become delinquent. And that's what happened. So what we could see is here between about October 05, where it started, to February 08, we can see that rise in the subprime delinquency rate because people started to struggle to pay due to higher interest rates. And then this resulted in them having to sell or default on their mortgage. When the subprime crisis occurred, then credit swap defaults came into effect, and this is where the foundations of the Great Modernisation Act in 2000 came into effect, because these were highly unregulated, and many businesses, this enabled many businesses such as Lehman Brothers to use credit swap defaults to achieve a profit. And this is where the issue came, because in 2008, a majority of their assets were from credit default swaps, and the issue is that the institutions that they bought them from, if they can't pay the principal and interest rates that they would promise Lehman Brothers, that if the bond was to default and they'd pay that, then Lehman Brothers would lose that asset. And that's essentially what happened, because these companies that I bought these from didn't expect the debt to come all at once, and they lost 400 billion worth of assets, essentially. And then secondly, Northern Rock, they financed a lot of their liquidity through mortgage-backed securitization. And obviously, as the financial crisis hit, mortgage-backed securities were less in demand, and therefore it's much harder to actually sell these mortgage-backed securities to create liquidity. Individuals caught on, and with the Diamond and Dybvig model of 1983, you could see why the bank run occurred, because Northern Rock didn't have enough liquidity to cover the consumers now and future consumers who would take money out, and those future consumers that would have taken money out came now in the present day to take that money out, which led to Northern Rock essentially defaulting and the Bank of England having to bail them out. And also it caused banks to reduce lending to each other as they focused on liquidity, and also they were unsure about the creditworthiness of the other banks. And we could see this having a big impact on the overnight lending rate, on the LIBOR rate. As we can see, that the LIBOR rate skyrocketed, because banks were unsure that if they did loan to a bank, would they get their money back? So they wanted to have the increased loan rate, which essentially was increasing the risk premium for them. The small part of the financial market which helped cause the great collapse was securitization. It wasn't the tool itself, it was the behavior, as banks were incentivized to accept as many mortgages as possible despite the household risk level, as the demand for securitization products was high and was easy way to achieve liquidity fast. And we saw Northern Rock using this as a main way to finance their liquidity, and obviously it came to their demise later on. Also, we saw that complicated products such as collateral debt obligations helped to hide risk of the Altay and subprime mortgages, as they were presented as AAA assets, either through being grouped with other asset-backed securities, or through credit swap defaults. And then secondly, obviously, that the mortgage-backed security market, because banks were just trying to get as many mortgages as possible accepted, despite the risk level that may have been included, we saw a saturation of low quality mortgage-backed securities in the market. And as more and more institutions held these assets, all it took was the right market to fall, which was the housing market. And any firm that held large shares of assets saw that they would become bankrupt, such as the Lehman Brothers. And also, we saw this behaviour of risk shifting, where firms felt they were too big to fail, and for example, banks were taking on anybody because all they would do is take the mortgage and then sell it on, and it's not their problem anymore. And all they do is have to push the interest rates to the special purchase vehicle. And also, again, the deregulation of OTC derivatives helped people like Lehman Brothers buy all these unregulated assets, and then later on see this come to their demise because these OTC derivatives unregulated, and when it came to them needing the money to be backed from the losses, it didn't happen because those companies collapsed. So thank you for listening, and I hope you enjoyed. And here are my references.